Right. So welcome to all of our clients and other viewers to this webinar today, where we are very privileged to have Ethan Harris to talk about the economy of the Fed at a very crucial time for that institution. And there's nobody better to do that. Ethan, for a decade, was at the New York Fed on the research side, briefing the New York Fed governor on going into Federal Reserve meetings, FOMC meetings, and then spent a long period running economics as the chief economist at investment banks, most prominently Lehman Brothers and Bank of America. My career in Bank of America coincided for quite a while with Ethan's. Ethan came in at a crucial time for Bank of America research at a time when the merger with Merrill Lynch had just occurred. We were in the global financial crisis. Over a decade and more, Ethan was one of two or three people at that firm who turned it back into I would say, the best product on the street. And given his experience at both the Fed and in sell-side banking, he's a great and guest to have on, and we're privileged to have him. So, Ethan, today, in the time that we have available, I wanted to talk about three things. One is the economy, the second is the Fed, and the third is what you worry about most with the long end of the market, because the clients and listeners to this webinar are kind of interested in borrowing costs, not just what the Fed's doing. So let's start talking about the economy. So we had Liberation Day at the start of April, and a lot of the investment banks immediately started to price in or put into their forecasts a recession, given the level. And now I know that we've had Trump backing off a couple of those in a number of percentage points of those tariffs, and exporters have found their way around some of the tariffs, but the tariffs haven't. So the tariff effective rate hasn't been as large, but it's still taking $30 billion a month out of the economy. It's a regressive tax, etc. And we ended up with an economy in the year that probably grew at about 2.5%. Significantly more than the high end of expectations when the Fed met in December. So how would you handicap the economy? Were you surprised personally? And what do you attribute that kind of stable growth of the economy relative to, say, the last prior couple of years?
Yeah, so first of all, thanks for having me on. And it's great to see you again, John. You haven't aged at all. I just want you to know that. So getting to the truth here now, on the on the growth outlook, so I was surprised at the resilience of the economy. I thought we'd slow to, say, 1% or something, not go into an outright recession, but much weaker growth. What we've gotten instead is a very kind of mixed picture. As you said, the Trump administration backed off on some of the worst of the tariffs. Tariffs are now something in the order of 15%, effective rate. That's up from about 2 or 3% at the start of the year. So that's not a trivial tax increase, but you didn't get the 30% type numbers that people are worried about. The other thing that happened was that there wasn't much retaliation. The most aggressive negative forecasts assumed there'd be rounds of retaliation where other governments would raise tariffs, the U.S. would respond, and so the liberation tariff was really viewed as kind of the tip of the iceberg of a bigger problem. That hasn't happened. And if you look at the impact on the economy of the tariffs, it's kind of a 0.5% of GDP price shock that's hurt growth, and an uncertainty shock, which I think actually is the big story, that U.S. companies just don't know what to do. It's amazing that the Trump administration's created more uncertainty in the U.S. economy than in its trading partners, because nobody has any idea how to plan their business now. You can see it in surveys. When people do anonymous responses to surveys, they tell what they're really feeling. And it's remarkable how much uncertainty there still is. And so you have a mild recession in the manufacturing sector because of that. But the economy's held in okay. We haven't had that really big shock. It's been helped a lot by the Fed. And there have been some offsetting fiscal stimulus along with it. Those two themes continue into the new year. So I think that we're going to see a year next year similar to a year of 2026, similar to 25, with a okay growth and sticky high inflation, which I'm sure we'll talk a lot more about. So it's not, and the final thing I would say on the trade war is we're entering a new phase in the trade war. Up to now, it's been basically the U.S. bullying the rest of the world. And countries have been trying to placate the Trump administration with concessions and promises that they have never really kept. All these investments they're supposed to do in the U.S. And so it's been kind of like a bullying process. And I think that's about to change. I think if you listen to what Mark Carney said and you look at the events around Davos, there's a shift in the war. It's going to be much more of a two-way battle where other countries push back. And so the trade war continues, but it's a little more, the shocks and the uncertainty will be coming from both sides. Uh-huh. And so I think that continues to be a major headwind to both U.S. and global growth in the year ahead. So since leaving Wall Street, I've got a little bit separate gig, and so I write both on LinkedIn and on Substack, a blog known as Ethan on the Economy. And it's been an incredible environment for following the economy and a lot of fun being in a more unfettered environment to say, what's really on my mind.
Are you expecting a continue? We always do these year-end or the year ahead outlooks, but essentially there's nothing magical about a year-end. There's basically a continuation until there's some kind of inflection point. And so do you continue to see, we have some innovation happening this year, like the net stimulus from the one big beautiful budget bill, which is supposed to stimulate capex in areas outside of AI, etc. But do you see a continuation of the situation where we have a continued K-shape, something like 20% of people do 60% of the spending, concentration of capex in particular sectors? Is there anything out there that could break that? We have a midterm election coming up, a populist government wants to flatten that K, if you like. How do you see that evolving?
Yeah, so I think that the K-shaped recovery is going to stick around for a while. If you look at think about the drivers of the K-shape. So in the consumer, you have upper income households with strong income increases and massive wealth gains, just unbelievable wealth gains since COVID hit, both in home prices and equity holdings. That has a lot of momentum to it. Those are gains that have been established now, and people have a lot of confidence in that most of those gains are permanent. So I don't think the high-end consumer is going to cave in anytime soon. I think that momentum continues coming into 26. And then if you look at investment, it's a similar story. I mean, it's very unbalanced, right? So if you look at the AI investment, it's booming with capital flowing into the sector dramatically, but that's got a couple more years to run, And now I agree, we're vulnerable. If that goes away and we don't see the rest of CapEx pick up, we're vulnerable. The same thing's true with the consumer. If the high-end consumer loses confidence, we're really in trouble. But again, in both cases, I think that there's no reason to expect a big change in 2026. I think the risks to the outlook are not so much endogenous. It's more the risk that the trade war gets really bad. And I know that the consensus out there is, oh, we're past the worst. Trump has backed off on a lot of stuff, but we need to recognize that he has managed to alienate every single trading partner of the United States. He's the credibility and trust in the U.S. has dropped dramatically. Public opinion overseas, I mean, I'm sure you'll see this as well, has turned dramatically against the U.S. And so the political pressure on leaders in Europe or Canada or other countries that are particularly sensitive to this, the political pressure is to push back against the U.S. and stop conceding. And that's why Mark Carney's out there as the front line of this pushback. It's because Canadians feel the most denigrated here. They don't trust anything the U.S. proposes. And so there's going to be the trade war could heat up again. And the third version of the trade war that we're probably get in 2026 could be that tit for tat, mess that everyone's worried about with liberation tariffs. Now, that's not my forecast. I think this will be managed, but I do think that it's still the number one risk is policies coming out of the Trump administration.
Okay, and as part of that, tariffs have probably had less of an impact on inflation than had been expected. I know we have some long-running and slow-moving elements of inflation that have come down, but probably we're all surprised at how little the net impact of tariffs has been on inflation. There have been a lot of offsets, etc. Yeah. And we also, but we're kind of stuck between a rock and a hard place. We still have, if you look at the bond yield, we have still very well contained inflation expectations in the bond market. But we're kind of between a rock and a hard place because we still have underlying inflation, the measures of underlying inflation still at about 3%. And so we still have a 2% inflation target out there. We can talk about that in a little minute when we talk about the Fed. But how do you see that rock and a hard place thing evolving in the next year? And is there going to be a breaking point, all else being equal at the Fed, that's going to get the bond market worried?
Yeah. So I like to, when I forecast, particularly now that I'm on my own and I don't have a big staff to whisper in my ear and give me lots of great thoughts. I've always felt in forecasting that what you do is you look at the consensus and you figure out what have they got wrong, right? Because that's the game we're in. If you're going to be a Wall Street forecaster, it's beating the consensus. It's not having a great forecast because nobody does. Mm-hmm. But if you can beat the consensus, then you're making money for clients. So what's the consensus now on inflation? Well, inflation now, there's a kind of a dovish bias in the way people talk about inflation. So, and this is not just in the consensus on the street, it's also the Fed. And what are we seeing? Well, there's way too much focus on the unemployment rate and the slack in the job market. The overall economy is tight. We have very high GDP relative to estimates of potential. There is still capacity pressure in the United States. It's not a good idea to focus exclusively on the job market when the difference, when you're getting very different signals out of GDP versus jobs. And that's what we're getting now. Jobs look lousy, GDP looks fine. So if you're going to forecast inflation, you want to be looking at the indicators of inflation pressure beyond just the unemployment rate. And they suggest that inflation is going to remain stuck at high levels. The other thing I don't like in the consensus discussion is they've kind of dismissed the idea that inflation expectations are high. People have accepted that the Fed's going to win the war on inflation, so they're not worried about inflation. And indeed, if you look at the bond market, as you mentioned, the bond market doesn't expect any real inflation going forward. But as an economist, and as I think about how to forecast inflation, I don't care what the bond market thinks about inflation. I care what the average person in the United States thinks, the average corporation and the average individual. Americans are super worried about inflation. We can see it in every survey. It would be remarkable if inflation concerns were so important to the political situation in the US and the problems the Republicans are facing in terms of the affordability concerns, and that had no connection to the way people behave in the real economy. So they've got two, one's a political view, one's an economic view, and they never talk to each other in your head, you know? So I think that there is some signs of higher inflation expectations. That's going to make it a lot harder to bring inflation down. So that's a second area where I think the consensus is wrong. And then the third, which we'll get to in more detail when we talk about the Fed, I think it makes no sense to argue that monetary policy is tight. I have no idea what that means. We've had, the debate has, over how to measure the tightness of monetary policy has devolved into R star, this idea that there's a funds rate that's, the gauge of whether you're tight or loose. So the standard number is 3%. So if the funds rate's above 3%, supposedly the Fed is really tough. If it's below 3%, they're being easy. And that's where the debate kind of ends. The problem with that is that this R star is a Maginot line, for those of you who remember World War II history. Tell this to financial markets. Why is it that for the last 3 years we've had a funds rate over 3% and at times way over, and yet the markets are booming? Where's the transmission mechanism where tight monetary policy hurts financial markets and hurts the economy? And why is it that 3 years of tight monetary policy has not generated something close to a recession in the United States? So to me, the markets and the data are speaking very clearly that Fed policy is not hurting. And if anything, in the last 6 months, the Fed has eased further. I think that this R star, to the extent that you can come up with a number, has got to be much higher than 3%. Maybe it's 4, maybe it's 4.5. And by the way, it's almost impossible to pin it down, other than to look at the economy and say, okay, well, wait a minute, does this pass the smell test? So the Fed is easy now. It's not tight. And it's gotten easier in the last 6 months. And so as we go into the new year, one of the things that for your clients should watch, and if they're concerned, say, for example, about where interest rates are heading, we're going into a pretty strong first quarter. You have the Fed easing into the quarter. Now they're probably going to be on hold for a while, but they've eased going into the quarter. You have very big fiscal stimulus hitting the economy in Q1 as the government reopens and as you get all these tax rebates go out to high-income families. Even if they save most of it, you're going to have a very strong first quarter. You could have growth of real GDP over 3% and nominal GDP growth over 6%. So you're going to have a booming quarter. And in an environment where the markets are deciding, well, there's absolutely no way the Fed's ever going to hike interest rates. And in fact, we're just waiting for the new Fed chair to cut them. And yet, and the markets are then going to have to look at a data flow that says the opposite. So if I was going to talk about short run kind of market stories, that would be my number one story, is that we're heading into a very strong quarter, very friendly Fed, very friendly fiscal policy, and so upside risk to bond yields. Which
brings us to the Fed, and Jay Powell, the curtain drops on his rather eventful 8 years of the Fed. We're probably looking at no Fed move, from what I hear from you in the next two meetings. And as you say, we're going to get some gangbuster numbers, probably even the fourth quarter, which is announced on February 20. That'll be a strong number despite the government shutdown. So we're looking at two very strong numbers in a row, probably a 6 to 7% nominal GDP two-quarter or three-quarter number, which seems 3 5/8 on the Fed funds rate is pretty good. Pretty good support for the economy with that kind of nominal economy. And then the question is obviously what happens in June. And it's interesting to see the reaction, I took a look at this morning. On January 23, when the prediction market suddenly started amazingly to say that Rick Rieder would be the Fed chair. And he went to number one, 50 or 60%, because Trump had said he was an intelligent guy. That shows kind of how weird those prediction markets are. But anyway, at that stage, Warsh was down to about 20 to 30%. But then we got the announcement of Warsh, and then I looked at what was priced in for the Fed. The announcement of Warsh, which would have taken him from 30% to 100%, only had about a 4 basis point effect on the Fed funds rate that was expected going out, say, 1 year. So the market didn't reprice the Fed, but it kind of repriced the balance sheet because, things like Bitcoin, gold, silver, etc., the speculative part of the market is kind of off. And so I want to talk about two things with Warsh. Well, the overriding thing is, we've had Volcker, then we've had Greenspan, Bernanke, Yellen, we've had Powell, and we think of the Fed as being their Fed. And so I think an important question from somebody who's very familiar with the Fed and worked with the Fed for a long time, is this going to be Warsh's Fed? Is Warsh going to be able to walk into that door? He's probably made some not dis-friends, but potentially some enemies there. There's some credibility issues, what he said in the interview to get the job. Is he going to be able to walk in there? And surely a Fed chair cannot say, well, I tried to get a rate change through, but I got outvoted. Does that ever happen?
Well, let me unpack that, because this is an amazing environment. So first of all, I've been watching the press reports around Warsh with a lot of sense of amusement, to tell you the truth. We need to remember who Kevin Warsh is. Kevin Warsh is a guy who at a very young age became a Fed governor. That was the height of his career. Since then, he's spent 15 years trying to become Fed chair, and he hasn't really done anything else. He gives a lot of speeches about how bad the Fed is, and they've made this mistake and that mistake, but he hasn't done anything, And so I have no idea whether he's an activist, the hedge fund he works at or not. But he's been campaigning to be Fed chair for a decade now, and that's his goal in life. He's not a guy who's going to bring to the Fed a depth of intellectual knowledge from studying monetary policy and understanding the nuances of the economy. He's a guy who, uses political muscle to get the job at the head of the Fed. Now, in terms of driving the committee, let's remember that even the big names you talked about all have challenges in controlling their committee, particularly at the beginning. They need to prove themselves. And these are guys who had great resumes, right? So you couldn't have a better resume than Volcker or Greenspan or Bernanke or Yellen. They came into that job and they were they were perfectly matched to the job. And so they came in with a massive level of credibility within the committee. What about Warsh? What happens with him? He's got 3 strikes against him. So if you're a baseball fan, he's probably heading to the dugout already. Number one, as you point out, his speeches have been incredibly insulting to the FOMC. He's not talking about the Fed of 10 years ago when he says they're incompetent. He's talking about this Fed. and he's very good about not naming names, because if he named names, then he would be really toast. But his message to the American people is this is a broken institution. People are biased and incompetent, and I need to come here and fix it. Okay, so that's his message to the FOMC. The second thing he's got going against him is he doesn't have a credible forecast framework. If you listen to his speeches, it's all a bunch of talking points. Where's the substance? Where's your forecast? How do you know that trend growth in the economy is accelerated and we're in a new golden age and therefore the Fed needs to cut? Give me the evidence. Where's your literature search? Where's the empirical work that you've done? Whose work are you relying on to come up to that conclusion? There's nothing in any of his. So he's got no beyond his very broad and critique of the Fed. There's no substance under there. So the committee's going to look at him and say, "Man, you got like 2 years to catch up here in terms of, we've been doing a serious debate here, and you're giving us talking points. That's not." And then the final thing.
Very interesting take.
I apologize if I'm insulting any Warsh fans out there, but the final thing is, what deal did he make with Trump? I mean, Trump is now, remember that this is all politics, right? So Trump is now backing off. He's not going to prosecute Powell. He's going to say the right things about Fed independence. Oh no, I wouldn't tell the new Fed chair what to do. He's got to make up his own mind. Oh, but by the way, I did talk to him, and he told me he completely agrees with me. And that has nothing to do with my decision to appoint him, right? So Warsh has told him he completely agrees with him, and Trump is saying, no, I'm not going to have any influence. I don't get it. What? So are you saying that that Trump is stupid and he doesn't understand that he's appointing a hawk or something? I think that when Warsh joins the Fed, he's going to have extremely low credibility.
They're going to be very interesting press conferences, though, because Fed chair doesn't dissent, right? Fed chair has a dot, but they don't dissent. So he's got to go out there. If he doesn't, he might be like a Steve Myron, wants a two and change rate. He has to go up to that podium and defend a decision that he may not agree with. Is what you're saying?
Yeah, I don't. It's going to be. It could be a very strange picture. I step back and look at this and say to myself, okay, if I'm a member of the FOMC, first of all, I'm proud as heck of Jay Powell. He stood up and did his job, and the whole central bank community supports him. Everyone outside of this small group of critics thinks that Jay Powell just pulled another Paul Volcker here with his resistance to political pressure. And if I'm a governor or a president who's watched this play out, I'm not going to cave in to a chair that comes in and tells me stuff that I completely disagree with. So I think that the narrative in the street is all wrong. Oh, is Warsh a hawk or a dove, and therefore do we get this or that? I don't think it matters. I think the committee, the only way he's going to get the committee behind him is through many months of proving himself and through getting into the weeds and addressing the specific arguments around trend growth and inflation and all the other stuff that the Fed's, feeding itself with a fire hose trying to figure out. And if the data helps, and if he can convince the committee that the economy can live with high growth and low inflation, he'll get them to vote with him. If the economy doesn't, they won't vote with him. So he'll just get outvoted over and over again. So
we've talked. Yeah, sorry.
Yep. So I don't think that. I don't really care if he's a hawk or dove. I think that what matters is the committee willing to base their decisions on economic fundamentals, or are they going to roll over and give in to pressure from the president and the new Fed chair?
Yeah, it's interesting. The when I go on the road with derivative logic, one of the questions comes up is about supply side and productivity.
Yep.
And that's basically a theory. We had from the mid 90s to the mid 2000s, we had a productivity boom, but that wasn't Reaganomics. That wasn't supply side Reaganomics. That was other factors. Reagan's reign ended in 88 or whatever. So you can't really base a policy on the expectation of a supply side boom until you see the whites of its eyes, right? Basically.
Absolutely.
So, yeah.
And that's the history of the Fed, right? So Greenspan predicted a new paradigm economy twice. Once in the 80s, when he was a private sector economist, he argued that we're about to have a productivity boom. A lot of that driven by hopes that the Reagan administration would trigger a boom. There was no productivity boom. So he was wrong about that. And then he predicted it again in the mid 90s when he started talking about the new paradigm. And then he was right. And so what did the Fed do? They waited for evidence. And then they changed policy. They allowed the labor market to get extremely tight in the late 90s because they could sense that there's a productivity revolution going on that was controlling costs. But that was based on empirical evidence in real time. Today, that evidence, we know that there's been some acceleration of productivity. We know that coming out of COVID, there seems to have been some change. It seems that companies adopted new business models, became more flexible in their use of their labor force. There was heavy investment in technology for communications. And so that does seem to have created an improvement in the trend in productivity. So we can accept that. What we can't accept is that, that administration policies have created a golden age that's already happening, and that the Fed is the only thing preventing it from showing up in the data. And that's the message that Warsh is making, and the administration economists. They're saying the Fed is stopping our golden age. Well, let's convince me that there actually is a golden age. It's conceivable that they're right, but there's also a good case that they're completely wrong. I mean, think about what Trump has done. Tax cuts on investment, great for investment. But the corporate sector's not investing because they have so much uncertainty right now. Only AI is strong. Everyone else is like sitting on their hands. So you can give them a tax break and everything else, but if you make the economic environment completely uncertain, there's no investment boom. Look what he's doing to the labor market. He's killing the growth in labor force. So that is not good for trend growth or a new paradigm age. So there are a lot of policies that the administration's following that are counter to the supply side story. The good news is that the Fed knows that. And the Fed, unlike Warsh, who's got this kind of like, this talking points approach, we've got deregulation, we got lower tax rates and capital, and therefore new paradigm, golden age. The Fed's looking at everything, right? They're thinking out of the box. They're saying, well, wait a minute. We've got massive budget deficits. We've got trade policy that's creating massive uncertainty. We've got this labor force reduction policy in place. We need to look at everything. We're not in the political game. We're in the economic forecasting game. And so that's one of the challenges Warsh is going to face. Okay, so he's going to come in, and now he has to put his arguments in the broader context of what the Fed has been looking at. So I don't think there's a golden age here. I'm particularly worried about massive budget deficit. That's a really big negative for potential growth because it means the government's sucking up resources instead of the private sector.
Yeah, and I want to talk about that just with a closing on what you worry about. Makes you lie awake at night about the bond yield, if it indeed it does. But instead of talking about two grizzled veterans talking about AI. I just wanted to get a quick response to you on this idea of balance sheet. We had all this quantitative easing. We've had a couple of rounds of quantitative tightening, but we have a large Fed balance sheet. There's been the accusations of modern monetary practice, fiscal dominance. We're at a level now where we're at ample reserves because, as reserves started to fall, we started to get some problems in the money markets, etc. So and we have seen some of the speculative assets sell off because we know what the Treasury Secretary and the Fed Chair-elect think about balance sheet.
Yeah.
How do you think that's going to play out? Is that going to be a long-run policy implementation by this conservative administration, or is it going to be something? I worry about a policy mistake.
Yeah. Well, I think that this is an area that probably has the biggest contradiction in the administration's message. It's remarkable. They just instructed the two GSEs, Fannie and Freddie, to buy mortgages, to push down mortgage yields. That's basically the same thing the Fed is, but that's QE and asset manipulation. At the same time, you've got both the Treasury Secretary and the nominee for Fed chair saying we should never have done any of that. The Fed should never do that. That's fiscal policy. You shouldn't be doing that. And yet there it is. It's right there. They just did it. So I guess it's because it's okay if the president orders it, but not if the Fed does it. So there's a big contradiction here. You can't flatten the yield curve and help the mortgage market by shrinking the Fed's balance sheet. You're going to increase the steepness of the yield curve. So I don't get what I don't understand what their view is. It's totally contradictory. My guess is that nothing big will happen because first of all, they haven't done their homework. If you're going to shrink the Fed's balance sheet, you need to go back to the old reserve regime and restructure the way you do policy. So why are they not even talking about that? They're just making it sound as though it just happens. We shrink our balance sheet. Well, if you shrink your balance sheet and you don't change the reserve system, you end up creating all kinds of volatility in markets and liquidity shortages. So the first step in this thing is to say, okay, so here's how we're going to move from the current regime back to the old regime of low reserves. So they haven't even started that conversation. So I don't know what they're going to do. I think that I would think that at some point, Rick Rieder. One reason Rick Rieder got positive comments from the president was because he told him, we should be buying mortgages, because that'll get mortgage yields down. So he tells the president to do the opposite of what the Treasury Secretary and the new designated Fed chair are saying. And Trump likes it. Oh, that's a smart guy. I hadn't thought about that. And so that just adds to the contradiction. For bond investors, I just think that most of the risks are upside for yields. Right now the market's pricing in almost zero risk of higher inflation or persistent inflation. You look at the pricing in the markets, you look at, for example, the pricing for the funds rate. The chance of a rate hike in the next year is about 2%, according to market pricing. Really? It's that low? It shouldn't be like 20%, Yeah, the Fed's more likely to cut than to hike, but it's been completely ruled out. And as you said, the pricing for break-evens is very benign. And so there's the risks are to the upside that inflation doesn't come down nicely the way the Fed is hoping, that there's still some tariff-related pass-through coming, that inflation expectations in the real world are high, that the economy could be booming in the first quarter. So I think the risks of bond yields are to the upside. And then, of course, you've got the existential risk to the bond market of runaway budget deficits. The Trump administration has zero interest in controlling the budget deficit. So
the budget deficit is still down, but it is it is down in the first 12 months of Trump mainly because of the tariff revenue, but also a little faster growth. But it's still still around 2 trillion a year. I checked on the trade deficit and the current account deficit. First it widened and then it narrowed because of front-running tariffs, etc. But we're still at about $1 trillion a year trade deficit, current account deficit. We're still, and it resonated your point about what international investors are going to do. There's already upside pressure on their bond yields. There's the hint of a weaker dollar policy. I do think that international side is going to be a key element to, this is the first time the Fed's ever eased 175 basis points and 10-year bond yields are actually higher. And I do think that international environment is one of those things. Tariffs haven't broken the global trade system. There's a lot of fiscal stimulus going on abroad. Yeah. And so I do think that that's one element that people in this space, even in commercial real estate, we all know that rates are set outside our specific activity. And I do think that's an area that should be watched. But I do have one parting question is when you are looking at, say, the 10-year bond yield, I'm not looking for a point forecast, etc. It's about 4.25% now. It's actually been quite stable. The Bank of America Move Index is showing low volatility. What are the main one or two factors that you would look at to see, 12 months out from now? What are the two things that you would look at most to determine where those kind of long-term borrowing costs are going to go?
Yeah, well, I think that there's two kinds of things. There's things in the fundamental backdrop, which I feel comfortable forecasting, and then there's the stuff, the wild cards. So I think that we're likely in a kind of 4.5% to 5%, somewhere in there with the U.S. 10-year yield in the year ahead, not necessarily right away. And I think there are three, actually, if you listen to my basic forecast, all three of my main calls are, lean towards a little bit higher rates, resilience in the economy, the fact that inflation won't come down as much as people expect, and the fact that the Fed won't cut interest rates. So the market is, but then you layer on top of that, this kind of gradual chipping away at confidence in U.S. institutions, the willingness of the U.S. to face the budget deficit, the wild idea that the U.S. might intentionally undercut the dollar, which is a bizarre idea. Using the dollar as a weapon in trade and so on. Why wouldn't, if I'm a foreign portfolio manager or somebody running the assets of a central bank, don't I want to diversify away from U.S. assets here, or at least bonds? Why would I want to be exposed to an environment that's got so much policy uncertainty and potential negative effects? I don't have any idea if and when the dollar gets under, serious threat. But I do think that, both the fundamental backdrop and the risks both lean higher on yields.
One thing that resonated with me was your thing that he's still campaigning. He's still got to get through the nomination process. And, so he's got a lot of supporters out there saying, don't worry about this guy. He's going to...
Yeah. And I think that, Warsh is really well connected. He knows a lot of people on Wall Street. He's worked with a number of people in the policy community, and I'm sure that they got along great with him. I also think that I think a lot of people are reluctant to criticize him in advance because they're hoping that, he becomes better in the job. In other words, he leaves behind the old, I'm trying to kill the Fed version of things. And once he gets in the institution, he starts working with them in a team manner, which is what some of these people have said. They said this guy's a great teammate. He's great at forming consensus and all that. Well, I hope that's who he is. But he's got so much baggage. And the idea that he's data driven, what data? He doesn't talk about the data. He's like, it's all big. So, he's part of that group, and that includes, Mickey Levy and David Malpass and all those guys who think the Fed screws up all the time and are constantly questioning the Fed's decisions. And even if you think they're right, that makes him fit in terribly at the Fed.
It is interesting. It's just another appointment to people. There's no center ground. People feel strongly in one way or the other. Okay. Well, thanks, Ethan. You've managed to make it both an erudite and entertaining half hour here, and it's nothing if not interesting. This is not a set and forget forecasting environment. There's a lot of uncertainty. The economy has somehow come through that uncertainty, growing fairly stably, but there's a whole new bunch of surprises in the year ahead. As you've mentioned, a couple of points where you think the market consensus is wrong, and I think that's hopefully useful to our listeners and our clients. So I appreciate the time you've given us today.
All right, thank you very much. It's been a pleasure.
Cheers.
Cheers.
Well, I do think one of the most interesting things is that the economy is the economy is based on the mean. The voter is the median. So you could easily have a strong economy this year, but folks, we didn't get to talk about the affordability issue, etc. But the median person, the median voter, that's why you get this disparity. Part of the reason you have the disparity between a vote where everyone gets an equal vote versus the 60% of spending that's done by 20% of the people. So that's going to be a really interesting factor this year, and it does tie the president's hand in policy this year because they need to try and limit the damage that they're going to get in the midterms. And that to me is kind of one of the things about, you're almost guaranteed a pretty strong economy this year because they're going to be pulling every lever that they can.
Right. And that goes back to your question about the balance sheet. If you're really trying to help yourself in the midterms, why would you shrink the Fed balance sheet? How does that accomplish anything?
Well, it reminds me a lot of there's an Australian rock band called Midnight Oil.
Oh, okay.
They're a famous band, but the lead singer Peter Garrett, they are world famous, believe it or not. You guys probably they're not a big rock music fans.
We're Americans.
Anyway, come on. They were very pro-environmental. All of their records over 30 years have been about the environment. He went into politics for a while, Peter Garrett, the head of the thing, and he took over the environment portfolio for the Australian government. Well, once he got into government, he realised how difficult it was. It's much easier as an outsider to talk about the environment than actually when you get in power. And okay, here you are, you've got all these critiques. Now what are you going to do?
Well, what we want is policy that has a nice beat and that you can dance to. That's the
I highly recommend. One of the worst things that happened in this last week is Rob Hurst, the drummer from Midnight Oil, passed away at age 70. But
really,
but there is a difference between being a critic and being given the reins, right?
Yeah, I mean,
for sure.
I mean, Warsh has got a lot of work to do. I mean, I'm not saying he's going to. He may give him a year and maybe he'll find his feet, and find his voice. But in the short run, I think he's going to be very ineffective, because the committee's just not going to want to work with him. Now, they'll treat him okay, right? They're very, it's a very collegial organization. They treated Mirren well, even though he's an obvious plant from the administration. And they didn't hide the key to the bathroom from him or anything. But yeah, I mean, I think he's got a long fight ahead of him, and maybe he's got the diplomatic skills to do it. I have no idea.
Well, it's going to be entertaining, and I think I really meant that. You've not only been erudite, but also entertaining, so and provocative. So hopefully that'll go down well.
All right, take care, guys.
Cheers. Thanks,
Thank you very
Ethan.
much.
Take care.
Take care. Bye-bye.